Investors who use expectation investing will have a fundamentally better way to evaluate all stocks, setting them on the path to success. That's a quote from the homepage of the expectation investing website. It was also in David's latest e-letter on the secret weapon to call the top in NVDA. And we'll talk about that a little bit later, but thought it was a great quote to point out and lead with today's podcast here.
Yeah, I mean, I think in a world where everyone recognizes the market is getting expensive, liquidity appears to has peaked, you know, and I think a lot of really smart people I've known over the years have said, look, valuation doesn't matter until it does. And, we're getting to a place where valuation appears to be mattering, and expectations investing is probably the best, if not the only real way to make sure you're not putting yourself at huge risk, or to at least know how much risk you're taking by being in some of these risky stocks, expensive stocks.
This is Intelligent Capital Allocation. I've got myself, Kyle Gusk II, and we're CEO David Trainer. And it's the 13th of September, Friday the 13th. Start off with the disclosures and disclaimers, quick review. We are publishing research. We're not providing any advice. You can take a look at these at your own time. The agenda, we've got a lot going on. We will be talking about what was going on in the community. Talking about some of our recent research, some different headlines, stuff going on with new constructs. Upcoming podcasts, we got one each month. You can see their dates: October 18th, November 15th, December 13th. If you're registered already, I believe you're already registered for all of those. You should get emails on them. Put out a ton of stuff, research since our last podcast, some long idea updates, danger zone updates. David's put out some different e-letters on different market topics. We finished up our macro trends and sector fundamentals research, looking at core earnings, ROIC, free cash flow yield, different metrics for the S&P 500, and then the NC 2000, which is our all cap index. Let's go super in depth. We've got client versions and then some abridged versions that are available to the public, so you can check those out. We'll share slides and with the replays, and all these links will be available to you guys. At the most overstated earnings, most understated earnings, looking at basically whose earnings are too high, whose earnings are too low compared to what we're actually seeing with our core earnings number, and then comparing S&P operating earnings to core earnings, a bunch of macro and S&P level work there. Different updates beyond that. David put out a video on how to read our stock reports. We'll talk about that a little bit. Put out most attractive, most dangerous, exec comp, safest dividend yields, and dividend growth stocks. Model portfolios had multiple updates, all available to clients as well. On the next, interesting headlines, we've got some articles here we'll talk about as we move into the presentation podcast here. And then stock picks. If you send us any stock requests, we'll probably have time to look at one of them at the end. We can take a look at it through our ratings. So if you put those into the chat or the Q&A, we'll gather those and find a lucky winner at the end, or maybe popular demand. We'll see if there's any repeat requests. But on the special webinars front, we do have an upcoming training, the hidden metric that reveals undervalued stars in the stock market. That'll be September 18th, so next week. We'll send out emails right now on that sign up. So the registration links for people to use. We're excited about that one. So I want to get as many people signed up for that as we can. Interesting headlines. This will be in the community as well as new constructs information as well. Talk about some things going on. First, got a model improvement. We updated the way we're treating interest and debt for home builders. You can see here that the main update, we're start treating capitalized interest as an operating expense instead of a non-operating, and then treat all debt as operating debt instead of financing debt. I think the overarching thesis or reason for this update is to better handle the debt and interest for home builders when they're using it to acquire land, which essentially then sell the product. So it's more of an operating expense rather than non-operating as it would be with financing. Let's see here.
One other comment I'd make about that model improvement is you're not going to find this kind of research, I think, anywhere else. I mean, tell me another research firm that said, hey, by the way, we've gone out and we've improved our earnings model to deal with accounting idiosyncrasies or accounting changes. Name another firm. Put it in the chat, put it in the Q&A. Name another firm that's doing that. We are constantly refining, improving, maximizing the effectiveness of our models. Those models already proven to be the best in the world by multiple independent third parties, and yet we're still at it. I think anybody who's ever performed at a high level knows, like, the only way you get there is by working really hard, and you don't stay there if you don't work even harder. And that's what we do. And I think that's just another thing that makes us very unique.
The next one, we've got a link we'll share in the chat here. David, looks like I'm not able to send to everyone, so I'm going to send it to you, and then you can hopefully share it with everyone.
Okay. Sorry about
But a video David put together on how to read our stock reports. It goes in depth on all the details that are available to the reports that you can get at our pro and institutional level, the different adjustments, different sections of the report. That's a great walkthrough on, again, how to read those reports. We'll send that out. And again, this link will also be available.
Free research on Amazon too, right? I mean, this is just helps people understand like the depth of the work. And it's in a 8 or 9 page, 10-page PDF. And like you're getting, in that one PDF, you're probably getting $25,000 worth of minimum of work on a company. I don't know, at least that's what it would take, expert on Wall Street. Like that's bam, and that's one ticker. And we do that for 10,000 stocks, ETFs, and mutual funds every day.
Yeah, a lot of times when we're sharing some of this, it's dated and whatnot. This is a recent report, so definitely check that out if you're interested in Amazon, as David said there.
Yeah.
No, I do not want to play that. I'm gonna go to the next one. Share a little bit of tooting our own horn here. We were ranked again #1 on SumZero for 40 straight months now. We're very proud of this. Shows the power of our research, stock ratings, and then basically putting that into action on those long ideas and short ideas, danger zone picks. We've got a bunch of different categories here that we are very proud to rank over, #1 against 16,000 plus buy side individuals. And what leads to those stock ratings is, recently finished up 2Q24 filing season. Went through 2,800 filings, just over that. Had some record days in there. Had 436 filings parsed on August 9th here. I believe that was a recent record. And so we're updating the models every quarter, every day when we get new filings, with a huge amount of value created for everyone that is using those ratings. And it is this work that drives all those ratings that can then create the #1 ranking on stock picking and all that. And so I want to point that out. And just again, we're very proud of the work we do, and we like to be able to share that with you guys. Next up, I think we're going to dive into some of the community topics, maybe some topics David's put together on, secret weapon we're calling the top in NVIDIA, kind of highlight what's going on in the community and in the market. I don't know if David, you want to start with the secret weapon post you did?
Yeah,
Talk about that a little bit.
Yeah, this post was, if you don't mind pulling it up, Kyle, I'll let you keep driving here. If that's okay.
Cool. Yeah, that works.
Yeah, this was like a big effort on our part to try and make the reverse DCF model more accessible, easier to use, right? Because so much of what we do, there's two reactions I usually get when I'm talking with clients, potential clients. The first is, oh, it's too good to be true. I can't believe this has been done. And that's really kind of gone away a lot over the years, but it still happens quite a bit, especially at the institutional level when people haven't heard from us. It helps a lot that we have this deal with Bloomberg. Yes, recordings will be available. Sorry, just going through a couple other questions here. And yeah, in terms of the Pacer, I'm sorry to get off track here. The Pacer ETF cows, just looking at questions here. Yeah, it's not real free cash flow. It's operating cash flow from operations. That's just a super easy, quick way. I hope someday we'll have a competing product based on a much superior version of cash flow, because ours is superior. And so that's a backdrop. Like, we got superior data, and one of the things people, they have a hard time believing in that. But then when we point out the fact that we've also got this superior valuation platform, right? We have all this great data historically, and we put it to even greater benefit by being able to roll it into a reverse discounted cash flow model. One of the most, if not the most sophisticated reverse DCF models in the world ever built. And look, discounted cash flow models are not easy to use. And so one of the biggest and first things I ever did when I was planning new constructs was, how do we scale this thing? And it's really not that hard when you break out of Excel, because Excel is like all single individual users. And for that, people are so used to Excel. I used to, I used to be an Excel guru. I think it's been a while. I'm still pretty good at Excel, but nowhere near the dudes that have been, cranking on it a lot more than I have in recent past, but trust me, I love Excel, but it's got limitations. You can't scale your Excel models. You can't make updates across multiple models at the same time. You can't do all the things you need in order to run an enterprise system like what we have. So we created that. And that's a big part of what the robo analyst does. And what it allows us to do is to do exactly what expectation says should be done at scale. And the most beautiful thing about doing this at scale, and probably the most important thing about doing it at scale, is that we have even better comparability around the feasibility of expectations baked into stock prices. We know where expectations are the absolute highest, most optimistic, most ridiculous, and the least, most pessimistic, most conservative, because we're looking at thousands of companies, which gives us the ability to create these screens, most attractive stocks, most dangerous stocks, with an unprecedented, unrivaled level of precision and accuracy. Thus, the great performance. Our focus list, thus the great performance. Some zero stock pick rankings, thus the great performance. Not only are we doing things with an unrivaled level of analytical rigor, but we're doing it at an unprecedented level of scale. And that's a big deal. And this reverse DCF model just kind of gets overlooked because, we've got all these great ratings, models, whatever, stock ratings, tons of great stuff. But then like when you can go in and drive one of these, I call it a weapon because no one else is doing this at scale, or no one else, and very few people actually doing this with, on individual companies, but you can put in whatever scenario you want. I say loading the weapon. Let's put in multiple different kinds of scenarios for NVIDIA. Let's forecast NOPAT margins and revenue growth at super high levels. What does that mean? What does that fall out? Then let's do something that's a little more conservative. And so when we do that, we can really take aim at like, what is the value of the stock imply? And so, in figure 2, this was done after I called the top. So I called the top at 126. And at the beginning of this report, if you haven't seen it, you can hear the recording. I'm not making it up. I called the top August 26th, and I think the stock was trading at about 126. And we wrote this a little bit while later. I'm not sure where the stock is right now today, but I think it's come back some, but it went down some more since then. And so, what we do is in that middle column in the blue and yellow squares there, we tell you exactly, like, to justify the price, it's got to grow at like 47% compounded annually for 8 years with a 513% return on capital versus cost of capital spread. And then on the left, you can compare that to what the company's done in the past. So the revenue growth is aligned with what the company's done in the past over the last 5 years, not as much as the recent past, but 47% over any significant amount of time is pretty ridiculous, especially for a company this large. What's even more ridiculous is that 513% return on capital versus cost of capital spread. And by the way, that's the average over the 8 years. And then in the yellow column, I say pessimistic. You can call it whatever you want. And keep in mind, you can do an infinite number of these in our system. The point is just to provide some examples for folks, right? So don't quibble with me about like, oh, you should be at 48 or 52%. If you want to do that, put it in there. That's the beauty. Like I love showing the portfolio managers we talk to, like, oh, you want to try 75%? You want to try 200%? Go for it. Put it in. We'll see what happens. We can do this as many times as we want. So I'm just throwing some examples out there. And in the pessimistic scenario, I say, listen, why don't we knock growth down a little bit, 29% instead of 47%, and margins too. So what happens? Well, now it takes twice as long into the future to get a value in the DCF model that equals the current stock price. Makes sense. If I'm not growing as fast, I'm not as profitable, it's going to take more time for the business to grow its profits, to grow into its valuation, to grow the profits that are baked into the current stock price. And that growth appreciation period number that gives us for the stock price at 117, 8 years and 16 years, that means that's the number of years the company's going to grow its profits. So after that 8 years, profits flatten out. After the 16 years, profits flatten out. There's no more profit growth. That's how you do this kind of work. That's what makes it a dynamic discounted cash flow model, because we're not out there trying to predict the future. We're going to look at multiple time frames. And as you'll see in the next part here, we're looking at out over 100 years. right? So the idea is when you are, you aim the weapon, you get the expectations, and firing the weapon is answering the question, do I agree with the expectations baked into the stock price? Do I think Mr. Market is about right, or expectations too high, expectations too low? And I think that's a much better position to be in than trying to be a fortune teller and predict the future. And so this figure 3 comes straight from the decision page of our models, just like figure 2 did. And you can see the implied values over a long period of time. And you can see that high growth in the early years is jacking the prices up. Exactly, right? And so the blue line, that's the optimistic scenario. That's the 8-year gap. The yellow line is a 16-year gap, and that's the pessimistic scenario. And then I think what's even more cool is on our decision page is this ability to look at historical revenue compared to future revenue, and historical profits compared to past profits, or historical ROIC compared to future profits. And I do that in the video replay. I toggle through a bunch of those. But this is just a great way to put it into context. Like, we know NVIDIA is a big profitable company, one of the biggest and most profitable of all time. But look at just how ginormous the future revenues have to be compared to what the past has been.
Yeah, when
This
you
is
see the
what's,
future, it makes the past look like nothing.
yeah, it's like they've done it's nothing. You ain't seen nothing yet, right? And that's when we say price for perfection. That's what that means. And so, these numbers here speak for itself. You're looking at 1.3 of implied revenue at the end of the growth appreciation period, 3.7 trillion in implied revenue at the end of the pessimistic growth appreciation period. And the next thing is to how does that compare? Like, I don't know what 1.3 trillion means. That's more than the 17th largest country in the world GDP, right? And keep in mind, and the 3.7 is more than the number 5 world, not number 5 largest country in the world GDP. I think that makes it pretty clear that those are some really, really big numbers. Now, part 3 here is like, okay, so maybe I believe in the revenue growth, but do I also believe in simultaneous improvement in return on invested capital? So we're seeing huge growth in revenue, huge market share gains, while also returns on capital going through the roof. Like, I don't think you can do both. Either or are extraordinary, both ridiculous. So you can see here the return on invested capital for NVIDIA at the end of the growth appreciation period for the optimistic scenario would be 839%. It would be 975% in the pessimistic scenario. Both of those are extremely high. I went back and looked at the S&P over the last 5 years. The number of times a company has earned a return on invested capital over 700% for any one period in the last 5 years, 0. It's only happened once, 600%, twice at 500%. And yet NVIDIA is going to do better than all of those, anything that's ever happened there. Way better at 839% while also growing revenue. Seems ridiculous. Anyway, we're gonna move on here, Kyle, because I think I've beaten
Yep.
this. The idea is that I don't think there's a snowball chance in hell that NVIDIA can achieve the expectations baked into the stock price. And this is the kind of work that goes into every one of our ratings.
I think that last point you mentioned on the S&P, how many times it's happened, also points to the scale that you mentioned in the beginning. If you don't know the companies, the S&P 500, and don't have models on them, you can't compare what is 839% ROIC mean.
Such a great point.
Great,
Right?
that number sounds cool, but what does that mean compared to everyone else? I think the chart here on Apple and Microsoft also speaks to that as well.
Yeah, it's hard to really honestly quantify how valuable like the platform like this is when you can not only do this analysis, but then have apples to apples comparisons across so many companies over time as well. Have we got any requests for tickers? There we go. Oh, there's some Q&A. There it is. My bad. I read an article that said NVIDIA chips were available from resellers in China cheaper than retail here. Can anyone verify that? I've definitely heard of people who've built businesses and had to shut them down. A friend of a guy I just met recently owns a small manufacturing business and does specialized manufacturing and had to insource it all here in the United States because he tried doing it in China. And lo and behold, he found out at one point that China was knocking off his very specialized builds and selling them to his same customers at 50% off. I mean, talk about biting the hand that feeds you. Question about companies in the new coverage queue. Yeah, I'm not surprised. I know we're working on some new companies. So Kent, thanks for asking. We're adding companies, and I know we're adding a bunch. I think there should be a few more coming out. I'm not sure if they're on your list or not. Yeah, Carl Mays, great question. Companies that have maintained a profoundly overvalued price based on sentiment, Wall Street narratives, et cetera. What's the longest? Yeah, I think I am saying NVIDIA sort of Three Sigma territory. And that's part of why we wrote the NVIDIA report when we did, is because it's about liquidity. As long as the liquidity environment is strong, we're not going to see any pullbacks, I don't think. I just think it's going to keep going on because there's no risk, right? And that's part of why I my ears perked up when the yen carry trade started to unwind and you saw NVIDIA get crushed. And I said, oh, this is one of the most leveraged names in the market. It's a lot of hot money going into this name. That's part of what's pushed it up so far, right? Clearly a crowded trade. Everybody knows it's a crowded trade. Wall Street, as I've written in some of my e-letters, they can afford to take the risk of being an overly expensive, super risky, crowded trades because they see the order flow. They're going to know that stock's going down before it goes down. And that flash crash we had back in the beginning of August, right? Institutions could trade, but could retail people trade? All the retail platforms were down, some longer than others. That's just another way of giving you a warning. When the music stops, you could be in real trouble. So that's part of what we do. We're not here to say that, like Carl, to your point, I can't tell you exactly when the music's going to stop. I can tell you, how dangerous certain chairs are or how unlikely it is you're going to be able to get a seat in certain chairs when the music stops. But I can't tell you exactly when. But I think it's about liquidity. And I think we're starting to hear that liquidity is coming down. Would it be interested to hearing what you think about Siri as it was announced that Berkshire Hathaway is now their largest shareholder? We'll do that. We can do Siri at the end here. Let's see what else we got here. We got a deep dive on counts. SMCI, awesome post by Ryan Mitz. Man, you got to check that out. I mean, Ryan does some great work. I mean, at some point we got to get Ryan on the team here because like his investigative reporting on what's going on to complement our work, unbelievable. And by the way, I want to make sure SMCI, we waved the red flag on that a while ago. Anyone who knows our work, if you look that stock up, we had suspended the rating because there was a big red flag about a lack of internal controls raised by the auditor. That's a big deal. In addition to the super expensive, you got to watch out. And then there's another post here that Garrett said. Is this Garrett talking about the poor disclosure?
No.
Yeah. I mean, dude,
Yeah,
boom.
this was back in the filing season 2023.
Yeah, in the community right there. We were out early on this. We've been really early. Sometimes we're too early. I get it. But you know what? When you look at our long side and you see the performance there, focusless long, and a lot of our other mono portfolios, the risk reward pays off, my friends. We're staying out of the junk, crazy, risky names, and we're giving people access to the better, the cheaper, safer names. What else we got on our list, Kyle?
We've had some great posts from John here on a lot of stock trades and options trades going on.
John is awesome. And for those of you that are pro and institutional, definitely check out John's posts on options and a lot of trading strategies. He's doing a lot of really cool stuff here. Yeah, I think a lot of our Prosperity Pub new clients and members would love John's work. He's doing some super cool stuff with the options. People ask us about options all the time. Look, we don't do any option research, but we do provide best in world, I believe, analysis on the underlying. So, when your option strategy is bullish, we can help you be smarter about which stocks it's good to be bullish on with an option strategy, or for the option strategies bearish, we can help you with that too. And all the combination of that. So it's just a better fundamental foundation for an option strategy because you got a lot of choices about where you want to make your play. And there's just better fundamental risk reward to make an option play or run an option strategy on stocks where fundamentals are better or stocks or fundamentals are worse, depending on whether or not you're bullish or bearish.
I'm going to go up at the top here. I think it was actually in the questions. Hopefully some community members will chime in. I saw a post on, is now the time for consumer discretionary stocks. There's a lot in the system that have good ratings, could be value traps. I think that's one of the topics people are looking at. So I'm hoping we get some more action and commentary on this one. It's definitely an interesting topic. And our consumer discretionary in our macro research, profits are looking good. They've been growing actually quarter over quarter, year over year for quite a bit now. But it's a situation of, is it getting, too hot, or is it, coming to the end of its time on the stock prices as, we look at interest rates coming down, or, consumer spending, where's that going to go? So I think if we can get some commentary here, that would be great from the community members. I know you guys are definitely interested in this stuff.
Yeah, and let's talk, and Ray, new member, welcome to Ray. Shout out to Ray. Made some great posts questioning about fixed income. I don't, I'm not a political expert, and this is a cop out, Ray. I just, and I think one of the things that I'm proud of at New Constructs is that we sort of know our limitations. We don't try to sort of, I don't know, wade into discussions where we don't really feel like we have an advantage or insight. So, one of the things, I think the takeaways that I've been reading is that the policies between Kamala and Trump are really not that different when it comes to taxes and most of these things. I think really maybe foreign policy is mostly where they're different, but for in terms of the market, the Democratic versus Republican policies are not that different. And we're going to probably see a split Congress, so nobody really expects much to get done. So sort of the difference between the two candidates maybe doesn't matter that much. That's what I'm reading. I try to keep what I'm reading very middle of the road. I abhor the extremes and will refuse to spend any time there. Don't watch any of the TV or any of that stuff. I don't play with that. I try to follow some people who are willing to do some of that and subject themselves to that kind of punishment and come out with intelligent responses on the back end. I'm grateful to those folks. But yeah, so yeah, it's tough, Ray. I'm really tough. We're not great. We're not fixed income focused. We do have credit ratings, and we can provide credit ratings at the macro as well as the micro level. And a lot of that you get, in the equity ratings too, if you just look at the quality of earnings. So sorry, it's hard for me to say which fixed income sectors or instruments are likely to perform more favorably depending on whether the election goes Democrat or Republican. I think my main takeaway is that it doesn't make that much of a difference. We're not going to see really anything pay off that well. I think there's some slight differences in the energy policies, but I don't see them as that different myself. So not a lot to say there. Yeah, Kyle, go ahead and hit the macro stuff, because we just published a new batch of macro research, and the macro research is some of the best stuff we do by far.
Yeah. Real quick, pull one of these up. I'm looking for the core earnings, showing kind of what we're looking at on how the earnings look compared to GAAP earnings on these reports. And then here is actually the consumer cyclicals item. Consumer cyclicals has been core earnings way up, GAAP earnings actually down in the most recent quarter. And so this is kind of the analysis we've got on all the sectors in those reports, and much more. We've got some details on the actual underlying drivers of each of the metrics. But I think the chart here, you're looking at earnings looking very strong, core earnings wise, the dip in COVID. And since then, it's had a super strong rebound. And so we've got, I think it's one of the few sectors that actually grew core earnings quarter over quarter in the most recent period.
And I just want to take a quick second, Kyle, to talk about, like, this data goes back at the sector level to the December 2004, 20 years. And we had this for every single sector. And in the main report here, you'll see that we have a breakdown for every single sector. So overall S&P 500, every single sector. And one of the things we see every time we do this research is that sector by sector, performance varies widely. So if you go back up to figure number 2, Kyle, go to number 1. No, wait, where's the overall S&P? Oh, we don't have the S&P 500 in this one.
No, yeah, I pulled up the public version just so we can,
sure.
This one's available for everyone to see.
Yeah, whatever we see, oftentimes I like to think about, you can go back down to those figure 3. The S&P 500 is sort of like the ocean, and everything kind of looks calm and flat compared to the sectors and underneath. Like, they're going, like, some are up, some are down. It's like wildly different, which is always fascinating. But there's a lot of normalization when you aggregate it all up to the S&P 500. And I think the other thing to point out is that we do this for return on invested capital, for free cash flow, for NOPAT margins, and capital turns. So you have a really, really, really amazing macro kind of work here across all sectors and all the major indices. Like, here's return on capital versus cost of capital. Yeah. Oh, there you go. And then you can see we also break out the capital turns and margins. So you can see capital efficiency headed down, right? Which is, part of why the tech companies look so great. But, what have we seen here in this AI race? Well, it's going to be a big capital spending. So returns on capital, profitability is going down on the margin. I think technology is kind of, sucked as much as they can out of the workforce and consumers. We've seen unprecedented margins for a long, long time. It's only fair to assume that those things have maxed, and now they got to go back into a spending phase to do something new that's going to create value. And I think that means on the margin, cash flows, returns on capital aren't going to be as good for a little while. Another quick question on the big picture environment, from Ray. Yeah, maybe liquidity is more important than policy. Yeah. Yeah. And to the extent policy affects liquidity, yeah. Because it's, as long as like you're still giving out money, people are going to still keep spending it, because that's what happens. You give people money, they just go spend it. And the more you give them, the more indiscriminately they spend it, which is what creates inflation, which creates capital misallocation and creates meme stocks, right? A meme stock is like a direct correlation to too much liquidity. People are going and playing meme stocks. We've got too much money. When stocks traded valuations like what we got with NVDA, we have too much money in the market and capital is getting wasted. And it's part of why we do what we do at New Constructs, is because we want to give people the information they need to allocate capital more intelligently, because that's better for society. We don't need to make the people in the Mag 7 and a Wall Street any richer. They're plenty rich. Last I checked, Zuckerberg, plenty rich. Elon Musk, plenty rich. Let's put this money into companies that are growing and creating real value. We don't need to enrich these other folks anymore. They're doing great. There's a crowded trade. Let's find places to put this money where it's going to make a better impact on society and do it to people that deserve it more. And that's a big part of what we do. And that accrues ultimately to the individuals, investors as well. That's the purpose of the capital markets, the way this thing works. And I think we're really proud. I was going to say, I think Wall Street's not in the business of that. And we are really proud to provide folks an alternative. And we're proud that what we do ultimately makes the world a better place.
Yeah, that'll do it. We'll get the replay up. We'll post that in the community of the video. We'll also share the slides in there as well. And we will see you out on community in the meantime. And then again here next month. So hope you guys have a great weekend. And until next time.
Thank you.